us humans have such a deep desire to complicate life. And I think we do it, and I am absolutely guilty of this. I think we do it because our lives have actually gotten easier. We are no longer being chased by animals with big teeth. There's no longer a danger of starvation from a lack of food. So I think our brains have kind of had a quandary or a problem with not having to struggle to stay alive. And in the face of that, we've really created this whole new way to kind of struggle. And that whole new way we struggle is by complicating life. We create huge amount of complication. We do this with investing. We do this when you have to go and sell something. Marriage, relationships, it happens all over the place. But because this podcast is about investing, we will stick to that and kind of the deep, deep desire to want to complicate things. Now, the theme this week is officially called This Should Never Happen, but it does all the time. So I want to point something out to you that according to the professionals or the conventional advisors or the big box advisors, they don't have to be big box, they can be independent advisors, but they think conventionally. The thing I'm going to show you should never, ever, ever happen. But in fact, it does all the time. And this evidence I want to show you, this is something that has to have you really question your approach. Not like question like it's wrong, but really kind of re-solidify like this is the way, this is the best way to grow and protect money. Hey everybody, this is RC Peck with my weekend podcast. And I want to talk to you about a company that you may have heard about before. This company is called Intel. Now, this company is currently the 24th largest publicly traded company in the United States. So it's really, really big. It's been around since 1968. 1968. So this has been around for a long time. Probably not going anywhere. Its annual revenue last year was $53 billion. It's annual revenue. That means every week it was making more than $4 billion in revenue. Like, this is a company that has clearly established itself, clearly is a global brand and a domestic brand. Clearly, any niche it goes into, segment it goes into, it's probably already owning it or gonna own it. This is a company that's not going anywhere. It's got over 100,000 people working for it worldwide. In fact, it's 107,600 according to Wikipedia. So this employs a lot of people. This is not something that was just started overnight by a couple people. This is a well-established company. And it has it almost has $100 billion in assets. Almost $100 billion in assets. So if it did liquidate itself, it would, bring in about $100 billion of money to pay off its creditors and its bondholders. So this company called Intel, which happens to be here in Silicon Valley, is not going anywhere. So the question is, explain this to me. Explain this to me why from May of 2012 to November of 2012, this company, this stock, fell. It lost a third of its market cap. A third of its market cap. People, that is $50 billion that evaporated. $50 billion. Now, its revenue was $52 billion. Its assets, or at that time, somewhere between 90 and 100 billion. But in 7 short months, it lost $50 billion of its market cap, or it fell 33%. This should never happen. Big box advisors could never explain to you why this happened. You should never have a company this well established, a company that just dominates its market so well, get cut by a third. Now look, this happened, you could say, oh, well, the stock market in May to November of 2012 fell. No, it actually didn't fall. It did quite well. In fact, the stock market in 2012 was up 11%. So it's not the stock market's fault. You can't blame it on that. This is incredibly inefficient. So anyone who tells you that the stock market is efficient, or you can't beat the stock market, or you should just buy and hold, clearly they've never done their homework, because the evidence states that really weird things that should never ever happen, in fact, happen all the time. Intel should never have fallen 33%. Now look, maybe Intel falling 33% when the stock market fell 58% from October 2007 to March of 2009. Okay, I got it. Sentiment changed. People were scared. They're running out of the market. And it really, people were really worried about their future. Totally understand why that would happen. But for the market to be going up and for a company like this, which is well established, to be cut by a third, that doesn't make sense. And this should never happen. And then what follows should never happen either. This should never happen either. You should never have this happen where it goes up by 59% in 19 months. That should never happen and add $47 billion back to its market cap. Anyone who tells you the stock market is efficient is not paying attention. They have not done their homework. This is where the opportunities lie. This is where you can grow and protect your future. This is where you can make up for lost time. Now, I'm putting a presentation together, and I want to show you a small bit of it where I'm showing to people why and how the market is inefficient and how you can really leverage that inefficiency by really measuring probability and inefficiency and using aligning to these inefficiencies. But really, this is not a $1 billion company that went up 59%. This was a $90 billion company that went up 59% in 19 months. This should never happen, but it does all the time. This is the approach I think you should use. This is the approach that can help you get more consistency in your growth of your investments. And this is just an individual stock. You can do the same thing with sectors. You can do the same thing with the entire stock market index, and you can do the same thing with the whole investment world. And I'll show you that in future conversations. But this should never happen, but it does. This is the evidence people are looking for, and this is exactly what can help you. This inefficiencies in individual stocks. Now, the point that I really want you to get, and the takeaway that I really want you to get, is that, look, I get that emotionally it might feel scary to buy even a company like Intel after it has gone on sale 33%. But if you step back and say, wait a second, this is not a startup that's 3 years old or 5 years old, though even if it was, that may not make a difference. It's far safer, and this is what I want you to take away from this. It's far safer and financially rewarding to buy established companies at a discount while they're still trending up. So this is not about buying companies that have been falling for 6 years, 7 years, 8 years, 9 years, like Eastman Kodak that went to zero, or Bear Stearns that should have gone to zero but stopped at 10 when it got bailed out. These are companies that are on a discount, at a discount, while they're still in their uptrend. This is the safest, one of the safest things you can do to buy an investment. Hey guys, this is just another step to help you get that fearless and secure future and present moment, so really you can be safe and secure and free about your future and today. Until next time, this is RC Peck.